this day a year ago, we had Lehman Brothers announcing bankruptcy, and this is when all the real panic started in the markets. Now, a year later, would you say that we've come a long way, and do you think that things are very different right now?
I think if you look at the banks in the States, certainly they've taken a lot of leverage off their balance sheets. But going forward, I think it's in our very nature that we are capitalistic, and to make money, people need to take risks. And the cycle will turn, and at some stage within the next decade, we're going to see another boom and bust scenario. We can't say in which area it's going to be, but that's the nature of humans. So the regulators will try to bring in restrictions and laws, governing it, but people will find a way around it, and we'll see the same thing all over again. We saw it 10 years ago with the dot-com era. But
would you say that we're setting ourselves up for another bubble, basically?
I think we need to be careful at the moment, just because the environment that we're operating in at the moment is very supportive for equities and for bonds, just because interest rates are very low. There's been a lot of monetary policy stimulus, and then we've seen a lot of government spending, and both those two factors have driven equities significantly high. We've also, last night we saw the US president saying that he's not going to take the crutches away from the patient. Just worried that we have the same sort of scenario as in 1929, when the measures brought in to help the economy were taken away too soon. So I think against that background, there's a lot of positive statements coming out from what people are saying now, and I think they're quite supportive, and we can see that in the markets, particularly the US market overnight. They started off weaker, and as soon as Obama came out with his comments, that they did strengthen.
We had FirstRand out with results today. It's quite interesting to note that the earnings that we've seen coming through, most of the outlooks paint quite a negative picture, but on the equity front, we're doing quite well. Just taking a look at those FirstRand numbers, you had a chance to skim through them. Anything that stuck out for you there?
Yeah, I think probably the two most important things, first of all, their change in strategy. They point to the fact that they're going to tweak their strategy just because they've seen volatility in earnings over the last couple of years that they're not accustomed to. With regards to that, what they're going to do is do more cross-selling within their division. So, from asset management to life insurance to short-term, and rely less on proprietary and investment banking, which tends to make spectacular profits when it goes well. But as we all know, the cycle did turn there as well. And I guess the other interesting thing to point out too is that the return on equity that they reported was 14%, that's probably below or at their cost of capital. And over time, banks typically generate a return on equity of 18 to 20%. So it's just showing that we're at the bottom end of the cycle, and profitability will improve going forward. It might not be 12 months, but certainly over the medium term, profitability will improve. They've got a good business model. It's widely diversified. Their management team is fairly strong. It's entrepreneurial, but with what's gone on in the last 2 years, there have been question marks raised over the management team vis-a-vis deal stream, the proprietary losses at RMB. But I guess we could say the same thing happened at Nedbank 10 years ago. They were the premium bank, always trading at a premium to the other banks, and they hit the wall. A similar sort of things happened to FirstRand, but not in the same degree. And we could see a re-rating from this level. It's worth pointing out that FirstRand's lagging the other banks. I think if one looks at the share price movement off the lows, the other banks all 60% off their lows, whereas FirstRand is 45% off its low.
Now, you mentioned that obviously FirstRand is lagging other banks, and apart from the reputational issues that it needs to contend with as well, would you be going into a bank like FirstRand right now? It is looking relatively cheap in comparison to the other major banks.
Yeah, I think if you compare it directly to the other three large retail banks, it does probably look a little bit cheaper, but I think by and large, that sector's probably run a little bit ahead of itself in terms of profitability. The market is anticipating, pretty much a V-shaped recovery in earnings, and expecting a fairly robust recovery in earnings for 2010. We think that's only more likely to happen in 2011, just because we don't think the unwind of impairments will be as quick. For us, I think if you have to be direct about it, that the most value is probably in the mid to small cap sector of the market.
On to another company, Pinnacle Kmart, with results today, a 3.6% increase in headline earnings per share. Very different space, a smaller company. What did you make of those numbers?
Yeah, it's quite fascinating. We saw results out yesterday from EOH, also plays in a similar sort of space, significantly good results from EOH. On Pinnacle, fantastic result. I think the market was expecting the results to go backwards quite significantly, and there were concerns because they've got a very dilutive BE transaction, but the trading statement came out about 2 weeks ago, and the share price is 40 to 50% higher since that trading update. So the results certainly surprised on the upside. Really good results. Going forward, it's on a PE of about 4.5, dividend yield of about 4.5. So it's difficult to see where you can go wrong on this one.
What's interesting to note is that the smaller companies are starting to come out with really great results, and in comparison to the bigger companies, one would say that the smaller mid-cap companies are faring far better than the top 40. How do you respond to that, and do you think that perhaps we should be looking into these other sectors for returns?
Yeah, I think probably the chief difference between the small companies and the large companies is their area of focus, and predominantly the larger companies focus on South Africa, on home soil, and I don't think the operating and economic environment has been as tough for some of them, as it has been for some of their global counterparts, and hence that outperformance. And I also think from a share price perspective, what we saw happening over the last 12 months, that there were significant redemptions as there was flight to quality. Hedge funds, unit trusts were getting redemptions, and they basically had to get out of small mid caps at any cost, and we're seeing that certainly reflective in some of the share prices.